Hello and welcome. You're watching Business Lunch. I'm Nisha Podar. With me today is Sumaira Abdi. But let's first take it straight to the top headlines at this hour. Bank Nifty and bond prices surge after the RBI announces a dovish bond supportive policy. Sensex and Nifty, however, are off highs as FMCG, auto and metal stocks drag, and mid-cap index is largely in the red today.
The Reserve Bank leaves rates unchanged but remains accommodative, saying it expects the current surge in inflation to be transient, thus holding out hopes for rate cuts later. It also says GDP will contract by 9.5% this year, but will turn positive in the fourth quarter as it's already seeing recovery. This is Reserve Bank's first GDP forecast this year.
The RBI ups the amount of bonds it will buy in open market to rupees 20,000 crore rupees a week and announces open market purchases of state loans as well for the first time. Now, bond yields fall by 10 to 15 basis points.
In a bid to boost lending, RBI announces an on-tap repo facility for banks to borrow from it at a repo-linked rate, which the banks must use to invest in corporate bonds or lenders' loans. RBI also announces lower risk weights for home loans where customer brings in more upfront money. NBFC and housing finance companies stocks surge.
Vedanta hopes to delist. The company's chairman Anil Agarwal tells CNBC TV 18 that he will make a counter offer if the shares offered in the current bidding process fall short of the 134 rupees mark. Now, a glitch in the BSE bidding system could also see the offer being extended if SEBI sees the need.
I have always dared to be an optimist, believing firmly in the ability of humankind to overcome the pandemic. In the months gone by, when COVID-19 raised in fury across the world, our hopefulness might have appeared impudent, like a flame flickering amidst a gathering storm. Today, there is a turn in the wind which suggests that it is not imprudent to dream of a brighter tomorrow, even in the bleakest of times. Relative to pre-COVID levels, several high-frequency indicators are pointing to the easing of contractions in various sectors of the economy and the emergence of impulses of growth.
All right, the Reserve Bank of India today didn't cut rates but came all guns blazing to support the real economy, the bond markets and the corporate sector. Lata and Ritu are standing by with all the highlights and the analysis. First, let's take it straight to Ritu for what the governor said on the economy. Ritu, over to you.
Well, unlike all the U, V, W and what have you shapes of recovery, the RBI believes that the economy will see a three-speed recovery, and for the first time now it has given a GDP forecast where it sees the economy contracting by 9.5% in this fiscal with risks tilted to the downside. In fact, RBI has given GDP projections until the first quarter of next year, where eventually you see recovery happening by the fourth quarter, and the first quarter of next year you see that sharp 20% uptick, but that is largely because of the base year. The governor also said that inflation is expected to inch towards the MPC target by the fourth quarter of this financial year. The targets that he's given, gradually, as you can see, ease by the first quarter of the next fiscal to 4.3%. The MPC believes that the current inflationary trends are transient, and this hump can therefore be looked through to use the space that then opens up as inflation eases to cut rates further as it remains in accommodative mode.
All right, Litu, stay on with us. And, there's cheer for the bond market. So naturally, we have Lata with us. Lata, what is it that the bond market is so excited about?
Well, all guns blazing. No one expected so many steps for the bond market. First up, they said they're going to, buy bonds in the open market. That's not great. It says that the amount has been doubled. Per week, it's not 10,000 crore, but 20,000 crore. But the most innovative step is, and maybe even courageous, is to buy in the open market state government loans. Everyone thought RBI will be scared because, at what proportion do you buy which state's loans? They've just boldly gone and bitten the bullet, as it were. And finally, bankers don't want to buy bonds if bond prices fall after that and they have to, mark to market and take losses. So RBI has said 22% of the total deposits can be invested and you don't have to mark to market. Originally, that was available till this March 21. Now they've extended to March 22. And that explains why you're seeing a near Diwali in the bond market.
Right. Thanks, Lata, for that. But stay on. We have more analysis coming in on the RBI's monetary policy. Ritu, coming back to you, also quickly take us through the relief measures which have been announced for the specific sectors by the RBI.
Well, to begin with, the retail lending limit has been hiked where, the maximum aggregate retail exposure you can take to one counterparty has been hiked to 7.5 crores from 5 crores for small and individual borrowers with turnovers of up to 50 crore rupees. And the incentive here is that the risk weight remains at 75%, therefore pushing banks to lend more to these segments. The second and the most important measure actually is the on-tap TLTRO that the Reserve Bank of India has announced for 1 lakh crores with tenors of up to 3 years. Now, there will be specific sectors towards which this will be targeted, and those are seen as growth multiplier sectors, and this will be available until March 2021. Generally, banks can deploy these funds either to invest in corporate bonds or even to lend to the specific sectors that RBI has identified.
All right, Ritu, thanks very much for that. But, before we wrap up this segment, there's another important point that we need to highlight, and that is what has come on home loans. Lata, what exactly is the impact and, what's gotten these housing finance companies so excited?
Well, in all countries and all civilizations, if you allow more homes to be built, it has a multiplier effect, because more construction, more steel, more cement, more jobs, etc. So this is a masterstroke, I should say. What they've done is they've linked the risk weight on a home loan to the amount of money that the home buyer himself brings. If the home buyer assumes a larger part, say for a 10 lakh home, if the home buyer is putting 6 lakhs, the bank's risk is less. Then it will have to keep less capital. Now, what does this mean? For every 100 rupee of loan a bank gives, 91 rupees comes from the depositor. The shareholder puts in 9 rupees. This 9 rupees is very expensive because you raise it from the market. Now, if you can keep less than 9 rupees, because the risk weight is reduced, you have to keep only 4 rupees for a home loan, then banks will be willing to give that borrower a lower rate, lending rate. And that's what will happen. Lending rates will fall very sharply for such home loans because capital is very difficult to get. And that is being excused, as it were. Makes sense, because the borrower is taking the risk on the home. So why should the bank assume so much risk? Now, actually, this facility is already available for loans up to 70 lakhs. Now it is available for all loans, all home loans, provided it's a new loan, not on your existing loan. This means, where is the problem in the housing sector? It is in the slightly luxury sector. Affordable homes are still going. What is not really selling is the luxury home loans. With this kind of a temptation that you will get it cheaper, chances are housing finance companies will get more business. Realty companies will see more homes going. There can be a groundswell of improvement in cement, steel, jobs, construction, etc. So I would think this is a winner of a piece.
All right, Lata, thanks very much for that. And let's also get in some reactions, from the experts we spoke to right after the policy measures were announced for home loans.
Risk weight on housing loans, which was dependent on 2 factors. One was the size of the housing loan, and the other was the quantum of loan to value ratio or the equity that the individual was putting in. Now what seems to have been done is that the cap on the amounts have been removed, and therefore everything is linked to the loan to value ratio, which makes housing loans more safer. Safer the loan you do, the lesser capital you assign to it. So that is really the right thing. Average loan to value ratio for loans that are given, typically, I'm giving HDFC's example, is about 68%.
About the 35% ratio, 35% risk weight is therefore about 60 to 65% of our loans. and we have a higher risk weight for the balance part. Now that risk weight also comes down to 35%, which makes it much more attractive. So I think that's the way RBI has thought of it. And this should be, again, one of the measures which should help the high-value real estate sector. But there are various other things also, of course, as we are aware, which needs to get sorted out and fall in place. But yes, this is certainly a step in the right direction.
Housing loans have got two advantages. One is this risk weight related harmonization only linking to LTV. So LTV linking without based on the amount of loan is a good measure where risk weights will be moderated in terms of lending. So I'm looking at that lending will increase. Second measure, co-lending inclusion of HFC is one important area. If you look at HFCs lend only to housing finance majority portion, and their pricing is definitely little higher than the public sector or commercial banks what they offer. As a result of co-lending, the interest rate that can be ultimately applied to the customer can go down from the HFCs overall in a combination. That is also a good measure by including HFC under co-lending. Probably we look at co-lending has not taken a very broad shape in the last 2 years since 2018, but we expect it to go a little further, at least in the housing segment area.
All right, so those were the reactions coming into the RBI's policy, and that has also created enough movement in the markets and the bond markets as well. With that, we'll slip into a short breather on Business Lunch. But up next, we tell you all that is happening with the Vedanta's listing exercise, and also tell you what the man himself, the promoter Anil Agarwal, has to say on this.